All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith. Derrick is the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussions here, as Derrick is a trader with T3 Trading Group, it means he is a regulated trader. So we just want to give you a quick look at his current positions as of the beginning of our conversation here, what he is long and short as of today, June 30th. So happy Monday, Derrick. We are sitting, let me look at the market, but record highs. We're still trading in this
We're at
record
all-time
high
highs.
territory. We're at
Yep.
all-time highs. I'm sort of, you never know. I looked like 10 minutes ago, but things can change on a dime in this market sometimes. So just have to make sure. But sitting here at record highs on a Monday at the end of June, kind of a shocker here when we think about how June seasonally is. How are you feeling about the market today, and how have you been navigating?
I mean, this market can't be more bullish. It's become one of the most bullish markets I've ever seen. And like always, this is entirely related to market dynamics. I was reading a research note from Deutsche Bank over the weekend, and the interesting thing about that note, it was talking about something I already know, which is that despite the fact that we're at all-time highs, despite the fact that there has been a massive rally from the April lows back to all-time highs, positioning is nowhere near as heavy as it was the last time we were trading in this area back in February. The hedge funds, a lot of them are actually still underinvested despite the degree of this move. The systematic funds are at more like neutral territory levels. They have more room to potentially buy as well. So the Deutsche Bank research note posited the question, which I already know the answer. It posited the question, well, like, how's it possible? How's it possible for the market to be back at all-time highs, but the bigger market participants that are out there, the bigger funds that are out there, their positioning is nowhere near to their previous highs, right? Because if you think about it conceptually, the market works off of supply and demand. So in order for them to have, in order for the market to go higher, there has to be more buyers and sellers. In order for the market to go down, there has to be more sellers and buyers. So how is it possible that we were able to buy us all the way back up to all-time highs, but the positioning from the funds isn't anywhere near all-time highs? And in fact, there's a lot of information that shows that hedge funds are still relatively underinvested. And it's because buying comes from multiple places. There's multiple potential flows that are out there. The biggest source of demand in the stock market in the year 2025 is corporate buybacks. It's the buybacks. And interestingly enough, almost perversely, all of the uncertainty that's ongoing right now with the economy, with tariffs, with everything that's happening, has led to a lot of the biggest companies out there not wanting to take the risk of hiring a lot of additional employees or doing a lot of research and development. Obviously, there's pockets of research and development that are very heavy, particularly in AI. But as a more conservative approach, companies are just increasing their buybacks. They're saying, like, all right, we're not really sure what we should do with our money right now, so let's just buy back more of our stock because it's a safe bet. And obviously, there are some perverse incentives for the management of companies to get their stock price as high as possible because they can make the most amount of money, and buybacks are a great way to do that. So corporate buybacks plus retail have been really the biggest drivers of this market as we've moved back up. But also it's been the chase back in now from hedge funds and a pretty consistent systematic bid, which is only scheduled to increase. The systematic bid in July from the vault control funds, it's becoming widely spoken about now, is supposed to be like the biggest in history for a 1 month period of time. We are expecting something like $114 billion worth of buying in the month of July from vault control funds if average realized volume is 0.5% over the course of that period of time. So we have been incredibly strong with this market. We're moderately extended with where we are today as we're having this conversation. So it would actually make sense for us to have a small pullback or a little bit of sideways price action. But it's hard to think that this market's going to be moving lower anytime soon unless we get some majorly detrimental headlines.
You and I talked about it a little bit last week, but you weren't able to share charts. I don't know. Hopefully, you can today, so to be a little more helpful for the audience. But June typically being a seasonally slow month, and it definitely was. We have slowly grinded higher to these new all-time highs. But when you look at the difference between April and May, it was definitely more of a slow move. If you want to bring up your charts, if you can, we can look at the market over the past month, whichever you
Sure.
want, the SPY, the Qs, whatever, whichever one is your focus. And we can
Sure.
talk, we can just do a review of June. So I can see your screen.
Absolutely.
There we go.
So June had been a very slow month up until the last 5 days or so. You can see here that pretty much for the entire month of June, we went sideways more or less. A little bit of an upside grind in the first half of the month, a little bit of like a sideways to downside grind in the beginning of the second half of the month when we were getting all the headlines out of Iran and Israel. And then it really kicked off on this day here, the 23rd. We put in a pivot low into the 21 EMA and had like a bullish engulfing candle closing us back at 600. I remember my partner Pat saying at the close on this day, he's like, all right, that's the setup for the breakout. We're breaking out. And he was correct. The next morning was the breakout day. So pretty much the entirety of the up move for June have been in the last 5 trading sessions, including today's. We had a massive technical breakout to break above the June range on June 24th. And that was a big day for the team. I was calling out, longs in the market, longs in NVIDIA, longs in Meta, longs in everything. The market is set to technically break out. And we've just continued. The interesting part about this continuation is it hasn't really been a momentum continuation. You can see that none of these last 5 trading sessions, including today so far, have been very wide-ranging bars. The intraday ranges have been pretty small, but it's been like gap up, grindy continuation, gap up, grindy continuation, gap up, grindy continuation every day for the last 5 days. Never just like that straight vertical up 1 to 2 big green days that I like seeing so much because one, you get paid very quickly on the longs that you put on for the breakout, but also that sets up the extension short at a certain point. The way that we've moved higher here, it's starting to accelerate a little bit, but it's never been to the point where I've been comfortable saying, hey, we should really begin to look for our extension shorts, except for we're maybe starting to get to that point today when you combine it with some other factors. So the way that I like to measure extension in the marketplace in any stock, in any ETF, on any time frame, is where the market is trading versus the 8 and 21 EMA. The 8 EMA is my blue line. The red EMA is my 21 EMA. So it's the 8 and 21 EMA. The space between the 8 and 21 EMA is what I consider to be technical equilibrium for any stock or any market that I'm looking at. So right now, I would say that the upper band of equilibrium for the SPY is 608 spot 71. That's the price of the 8 EMA right now. The lower band of equilibrium is 600 spot 72. That's our equilibrium zone. Where are we trading right now? We're trading at 616 spot 85. So we've got, I don't know, $8 of upside extension in the market right now. $8 on upside extension. Now I have another exercise that I do. It's just like a general way to view the market and think about the market at the index level specifically with the SPYs and the Qs is I kind of view extension in 3 zones. If I am less than $5 above the 8 EMA in an upward trending market, I don't consider that to be very extended at all. The trend is your friend. The market's moving higher. You're not very extended at all. You should be looking for long continuation trades. When we get to the space between $5 and $10 of extension, which is where we're trading right now, that's the area that I consider to be, I call it no man's land. It's just not a great risk reward and probability of success to do anything new. If you're buying the market here, you're chasing a little bit, and you have to recognize this market could pull back to 605 and still be very healthy. So if you're buying 617 and we get a pullback to 605, there's a good chance that you're getting stopped out for a loss at exactly the spot where you should be looking to buy the market for that next setup. So between $5 and $10, it's kind of no man's land. I don't have a good risk reward on new longs, but it's not a good idea to really come in and short the market either, because we're beginning to extend, but we're not at what I would call extreme extension. So if you begin to short here at 617, really extreme extension would only begin if we got to 619 today. And I say today because tomorrow that ADMA will be even higher. So you need a degree of the market moving up quickly in a short period of time in order to market in order for the market to hit that extreme extension zone of $10 plus from the ADMA. And again, you can just see this 5-day breakout that we've had, because there has not been a big giant positive green Maribozu that has taken this market up very fast in a short period of time. We've never really gotten to $10 plus away from the ADMA. We haven't gotten to that extreme extension zone from the market, where only at that point can you even begin to consider going short. Sometimes it's actually still too early. Again, this is a guideline. It's not a rule. It doesn't mean as soon as you're, trading at $10 from the ADMA to the penny that you should be putting on counter trend trades. You can reference back to April, where we had gotten more extreme extension from the ADMA than I had ever seen at any point in my career when we were at lows. So you can have these more anomalous situations where it can increase dramatically, but it's in that area. If we get to 610, if we get to $10 plus away from the ADMA, that I would begin to consider looking for counter trend shorts, just because of the degree of extension we have oftentimes means, especially if it's like a day 2, day 3 or more to the upside, that the market is due for some sort of corrective action through time or price, and you could take advantage of that through some cuter counter trend type of trades. But the thing with this market, again, is we just haven't been able to extend higher to get there in the SPYs. For the Qs, we actually did get there briefly pre-market this morning, and now we're back below it. Right now, we have about $9 of extension from the ADMA. At one point pre-market, we had basically exactly 10. So it's the same deal. The Qs may be slightly more extended, but they're not getting us to that extreme extension point where you can consider looking for the other side either. So we're just at a spot here these last couple of trading sessions where we keep moving higher, but to do anything new is just kind of presenting a bad risk reward and a lower probability of success, unless you're focused on an individual stock that has news, a company that got upgraded or had an earnings report or had a significant piece of news that will lower its correlation from the market, and you can potentially focus on it. Now, for today's trading session, I did tell the traders that even though we're not at that extreme upside extension, you might be able to look for some shorts today. And so far, that has not panned out. This market has been completely going sideways on the 5-minute chart. Actually, we're starting to grind higher. And one of the things I was telling the traders before I got off the radio at 11 o'clock is, remember, in this situation, time is a bull's friend. The more we move sideways here, the more it satisfies extension. But I did think that there was a potential, even though we're not at extreme extension, to look for some shorts today, because we've got a really big pension sell rebalance today. So at the end of the month, and particularly at the end of the quarter, the big pension funds, and the pension funds, they move a lot of money, they are required to rebalance their portfolios. So, a pension fund, obviously, the idea behind a pension fund is just to help people save for retirement. They're not supposed to be taking really big risks. So they typically manage a portfolio that combines equities and bonds. Maybe a 60-40 portfolio could be as an example, or maybe they have a 70-30 portfolio, meaning 60% stocks, 40% bonds, and that should be on a dollar value. So what happens in a given month if the stock market moves higher and the bond market moves sideways? If the stock market moves higher or the bond market goes down, or even the stock market moves higher and the bond market moves higher, but the bond market doesn't move up as much as the bond market did, then you get a rebalance that needs to take place in order to get back to the 60-40 or 70-30 or whatever the mandate is of that pension fund. So being that it's the end of June, this is both an end of month rebalance, but it's also an end of quarter rebalance. And you can see over the course of the quarter, if you look at April, May, and June, the TLT, which I'm just typing up real quick as a representative of bonds, of treasury bonds, is down, but the market is at all-time highs, and it's significantly higher than where we were in April. So therefore, pension funds are going to need to sell stock by the end of the quarter, the end of the month, in order to rebalance their portfolios and buy bonds. That's a systematic flow. So knowing that the pension and the estimated number I read is $28 billion of selling in equities, knowing that it's a day 5 to the upside, knowing that our short-term tactical was in the red zone for the second day in a row this morning, knowing that the SPX was gapping above the upper Bollinger Band, but not having the $10 of extension I really like to have. But we've got the pension salary balance. I was like, all right, today maybe is a day where we can look for some shorts. So far, that has not panned out. We'll see if we roll down into the close. A lot of the movement that will occur off of rebalances typically takes place via market on close orders. So we might have an exciting close today, even though the intraday price action has been really boring. We'll see. With all that said, if I know that there's $28 billion to sell from pension funds, then everybody knows that there's $28 billion to sell from pension funds, and that number can get front run a little bit. So we'll see what, if any, market impact we get into the close. But it feels like today is the last chance to get the market to go down, because once we go into July, like I was saying to you before, we're going to get the vol control bid that comes in. It's the 3-month realized look back on vol drops off from April, and there's going to be $5 to $6 billion worth of buying from these systematic volatility funds potentially every single day on average in the month of July, and it's going to be so hard to get this market to go down. So we're bullish.
All right. Two catalysts or news events coming up for the market. The market is focused on, seems to be optimistic about as well. Is the tariff deadline July 9th and the budget bill that's currently making its way through the Senate. The big beautiful bill, according to Trump. Which one of those do you think the market cares about more, or do either none of them matter? We're bullish and we're going to go higher and whatever. Barring some crazy bad news about trade.
Sure. So they definitely care about both. Taking one at a time, the July 9th deadline for tariffs, I think that the market feels pretty confident, and I've been pretty confident that if there are trade deals that still need to be done by that date, then we're just going to extend the deadline. So it seems to be what the market's pricing in. It was interesting to see that on Friday, it was the first time in a while that we saw a negative trade headline, and it also moved the market down, albeit that lasted for just like a couple of minutes or so, and then the market was able to rebound and rally right back into the close. And then, of course, we gapped up this morning because it was all good with Canada. But this was related to Trump saying that we're going to hit them with more tariffs because they're doing this tax thing on whatever it is, like e-services or whatever. It's like a services related tax that Canada and Europe are trying to do on us that hits our tech companies. And Trump didn't like that, so he said negotiations are going to hit you with tariffs. And then Canada seemed to acquiesce over the weekend, and conversations are back on. But it was interesting to see that for the first time we actually were able to get some selling on a tariff-related headline. So the market seems to be fully pricing in that we're going to extend the pause. My expectation is that we're going to extend the pause, but you also never know. This administration, Trump, it's always a wild card. There's always a chance that they just come out and change their mind or whatever. So it's one. And then two is the big beautiful bill. The big beautiful bill could be, at least in the short run, pretty bullish for the stock market. It increases deficit spending. Increasing deficit spending is bullish for the stock market, at least in the short run. I did read one piece of research that said that by 2033 or 2035, the extra debt that we're going to be incurring will actually begin to negatively impact GDP. But 8 to 10 years from now, who cares? We think about stocks and markets in terms of days and minutes, not in terms of decades at this point in time. So for the moment, it should be just bullish, bullish, bullish. Everything is bullish. And even when we have bad news, the bad news just runs into a massively positive gamma environment and a huge vol control bid. So I don't know how we can go down.
All right. So ultimately, bullish market heading into typically seasonally bullish month for the stock market with July, and all of the factors you've talked about just making it an even more bullish July than usual. What do you like here at record highs as a buy, maybe a short, a long, a day trade, an investment? What are the ideas that are floating around for you? I know you start index level and narrow down from there, so we can talk about ideas.
Yeah, so at the index level, we need this market to reset up. So yeah, we can do the screen share again. We just need this market to reset up. It's like I said, we've been trading in what I call no man's land. No man's land is exactly what it sounds like. It's just not a good spot to be doing a lot more new trading from risk reward perspective based on the big picture. And for me, even if I'm taking a day trade, the day trade always starts with the big picture, because if the big picture is on the side of the day trade is going to have a higher probability of success. So the indexes are saying to me right here, right now, basically do nothing. Or if you forced my hand to do anything right now, I probably would look to short just to help, just to participate in a extension satisfaction trade. But all that would do would be to set up the long. It just sets up the long. So if we pull back into the ADMA on the daily chart, that would be a spot to then begin to look for that next pivot low, that next long setup that we can get continuation from. And then there's so many different stocks that you can look at. What has really led the market higher is the AI trade. I see no reason for that to stop. It is all about the AI trade. NVIDIA, too extended to do anything new with here, but we had just called out NVIDIA as a long through 146 for the breakout. And this is the thing I love about swing trading, by the way. What I love about swing trading is you can just do a really good job on one day and then continue to get paid for it for potentially days or weeks at a time after the fact. If you are still long NVIDIA from the 146 call out and it closed at highs, so you swung some, the next day you got paid more. And the day after that, you got paid more. And the day after that, you got paid more. And right now, is Nvidia green? Yes, it is. You're getting paid more. That's the beauty about putting swing trades on, is that you can do the work one time and you can just have it pay you sometimes for days or weeks if you just kind of continue to follow the trend and let those bullish charts play out. But you gotta love these AI names still. The semiconductor names have just been on fire. Micron's taken a little bit of a pause post earnings, but the earnings report was fantastic, and it's probably just setting it up for further continuation. AMD, it's a bit extended. It could also use a further pause, but it's probably also just a setup for continuation. So we got to keep those names on the radar to potentially give us another leg higher, because that is 100% where the money's been going. I think that the IWM is going to outperform in July. So I do like mid caps and small caps. I also think that we're going to see a continued short squeeze occur at the institutional level. Like I was telling you before, part of what has, you know, been moving this market higher on the last leg has been these like stop-ins from funds. And the next leg of that, I think, is going to be a continuation of just them getting stopped out of their shorts. Because a lot of people, and myself included, I have an economics background. I look at the macroeconomic environment and I'm very fearful of it. I do not like tariffs. If you've ever studied economics in college, you understand that tariffs are destructive in the long run. But they're not showing in the data yet. And even if they were, it also doesn't matter. We've seen a bunch of bad economic numbers come out. I think we're getting ISM services and manufacturing numbers again this week. I think, fact check me on it. But last time those numbers came out, they weren't good. Market didn't care. Market went down for like 7 minutes and then it went back up. Why? It's everything I was just talking about. It's market structure. Market structure matters more than literally anything. And where we are in the market structure cycle is that this market should continue to move higher in July. I think that there's going to be a lot of pain still from the shorts unless we get some really crazy headlines that come out that can increase volatility. If there's no increase in volatility, this market's going higher, and getting an increase in volatility is almost impossible because of all the vol selling that's ongoing as a self-fulfilling prophecy that negates volatility. So that's just kind of the market dynamics. So I like mid caps, I like small caps, I like just looking for whatever that next squeeze is. Ion Q had a wonderful breakout today. Unfortunately, it was not on my radar. But one of the other traders on my team mentioned it. But beautiful breakout in through 42 in Ion Q. Just find the stocks that can squeeze. They're moving like the BBAIs, BBAI. These names of the world are moving again. I think SOUN is on the move again. Sometimes these companies are crappy companies. It does not matter. What's QS doing today? Yeah, QS, they started to squeeze. I think that's going to be, what we continue to see. You can look for those for day trading longs, and that's where we're at.
All right, we have a couple of requests here, Derrick. Anne from X asked if you can look at Nike stock.
Yeah, so Nike is an interesting one. I didn't think that the Nike earnings report was phenomenal. They're expecting to take a 3/4 of a basis point hit. Sorry, 3/4 of a percentage point hit on their margins related to tariffs. But they also said, because Nike's been going through a really big transition after making some mistakes around COVID with how they were doing their business. They also said that they think the worst is behind them. So I think it was a good report, not an excellent report, but the stock is so beaten up into it that it was probably all that it needed. I like Nike a lot as a company. I've always been very biased towards them. You could certainly make an argument that they're not the only game in town anymore, which is what was so great about Nike for a long time. And you can make an argument with almost everything in retail that they're going to struggle because of tariffs. But I actually think in the short run, we're going to see a retail squeeze because if the market keeps moving higher and people have been trying to pound the Nikes to the ground, the Macy's to the ground, to some degree, even the Walmarts down because of tariffs, the market's going to cause these names at a certain point to go higher and it's going to squeeze those shorts out. So I think that big picture retail is going to have some problems, but short picture over the course of the next month, month and a half, these names are probably going to continue. So I like Nike for higher. I don't like to chase price, and this thing's a little bit too extended. Remember, it's trading at 71.40 right now, but our ADMA, because the earnings report gapped it up so much, is all the way down at 65.40. So after a big earnings gap like that, I want to see this reset up. I want to see it go sideways, build out a new base, build out a bull flag, let this ADMA catch up to $68, $70, and then maybe you can look to push for the next leg up.
All right. Brian from YouTube said a VIX hedge, like Derrick said a few videos ago, is still a wise trade. I have some UVXY calls. So do you still like this trade?
I do still like the trade. I do have some VIX calls on myself. It's interesting to see today in particular that the VIX is positive with the market. So the VIX, it's a little bit below, where's my charts? It's a little bit below Friday's high now, but the VIX was basically spending most of today trading above Friday's high while the market is also trading above Friday's high. Some people are saying maybe that's because of the pension rebalance. Some people are saying maybe it's because of this JP Morgan collar trade that has to roll into its next period. I'm not 100% sure. It is something that we always want to pay attention to when we get those VIX divergences because it can be a signal for something more. I like the upside on it. I think that I might be early with the trade. I had VIX calls on for July, and I think it's early. I think that this is more. I think it's potentially more of like a August September move. So be a little bit patient with the trade, but I do like having some upside on there.
All right. And then Brant said Apple's kind of stuck sideways / lower as the rest of the market is at / near all-time highs. Thoughts on Apple going forward?
So I don't like Apple long. It pains me to say. I'm
Okay.
such a big fan of the company. I'm a big fan of the stock. I'm an iPhone user. There's so much like about Apple. The biggest thing about trying to be short Apple is the buyback. The buyback is just so insane with Apple, and you are fighting it the entire way. But we're probably at or near the buyback blackout period of time for Apple as we approach its earnings report. It probably starts 3 to 4 weeks before Apple reports. I'm not exactly sure what Apple's earnings report is, so we should be close, if not at that Apple blackout window. All that means is that it makes it easier for the stock to go down, because if Apple sells down, it's not running into its own corporate bid, assuming that we're in that. But the stock has gotten it's expensive. It's expensive relative to history, and part of the problem with that is they're seeing a little bit of a slowdown in their services growth, and services is one of those aspects that give you a higher multiple. So if you're getting a services slowdown, and you're also potentially dealing with some tariff headwinds, and the market is viewing them behind in the AI trade, it's creating a lot of relative weakness at a time when the stock is also expensive. So I think Apple's a fantastic company. I love the idea of buying a big dip in it. But I don't want to be long this stock here. I just think that the multiple is too rich for how the company has been doing. And that's pretty much it. There's been some chatter that I've seen in a couple different places that Apple should buy Perplexity. I don't think it's going to happen. It's just not how Apple rolls. Apple is not in the business of making big acquisitions, but they've been so far behind in the AI trade, which at first seemed genius, and maybe it'll still prove to be genius. Apple in the past has done such a fantastic job of never being first with a new technology, but doing it the best. So with that said, they've been behind on the AI trade. And at first I was like, oh man, Meta and Google and Amazon, all these companies, Microsoft, they're spending so much money on AI that if that doesn't come to play, they're going to be wasting billions, trillions of dollars for all I know. And Apple might come out looking like the genius because they're like, we're not going to spend all this money. We'll just onboard, Google's or Meta's or whichever one actually has the best product. And now it looks like they're being punished for it. And there's been some chatter maybe they would buy Perplexity to catch up. It seems unlikely, just knowing the history of how the business operates. But I bet if they did, the stock would really move higher on it. Most of the time, when a buyout of another company occurs, the company that's doing the acquiring goes down because they're either doing a massive cash outlay or they are doing, some sort of a stock-based deal which increases the tradable float, and then it's just supply and demand, the stock goes down. I think if Apple bought out Perplexity, they've got more cash than anybody out there. They could do it. They could afford it, and the stock would probably be at 240 really quick. So keep that in the back of your head with all the chatter that's been out there. I think it's unlikely, but it'd be really interesting if it happened. Otherwise, if the market itself ever goes down, which who knows if that's ever going to happen ever again, it certainly doesn't seem like it. I'm being moderately sarcastic. Then I think Apple goes lower, but we need the market to go down.
All right. All right, everybody. Let me pull where am I? All right. Derrick is a real trader, so I want to let him get back to that. It is the last day again of June. Tomorrow is a new month, a new quarter, and it's typically a pretty good month for the market. So in a very bullish setup for July. So Derrick, I'm gonna let you get back to trading. Have a great rest of your Monday and a great rest of your week. Everyone remember it is a short week for the market. Thursday is a half day. Market closes at 1 p.m. Eastern time. Friday is a day off for 4th of July. So enjoy the short week. Have a good one, Derrick. We'll talk again in a week about July. See how the first few sessions are going. Talk to you later.
Thanks, Retta.
Oh, and everyone, you can go to t3live.com/GOLive. I can even read it if you want to get Derrick's free ebooks. If you like anything he said here, that ebook will tell you how you can work with Derrick and the prop trading group over at T3 Trading. All right, now goodbye. Have a good one, Derrick.
Sounds good. Thank you.
All right, bye.